Hi, welcome back. In this session, I'm going to lay the groundwork for thinking about how corporate finance decisions change as a company ages, as it goes through the life cycle. Now, as a prelude though, I need to establish some basics of corporate finance. So if you have already taken a corporate finance class or feel comfortable with your corporate finance basics, feel free to skip this session. You might not need it. But as somebody who believes that corporate finance is at the heart of almost everything we do in business, let me explain what I see corporate finance doing. The big picture of corporate finance, which is what I start my classes with, lays out what I think of as the first principles that drive how to run a business. And ultimately, every decision that a business makes has to fall into one of three buckets. It can be an investment decision, a financing decision, or a dividend decision. Investment decisions relate to where to invest your money as a company, what kind of projects to take, what kind of assets, including acquisitions. So along the way, there are two subparts to that decision. The first is, what hurdle rate are you going to demand when you make an investment? Obviously, riskier investments have higher hurdle rates than safer investments, but we still have to measure risk and bring into our hurdle rate the mix of debt and equity we use to fund an investment. We compare that hurdle rate to the return you make on that investment. That return, done right, should be based on cash flows as opposed to accounting earnings, should reflect when you get the cash flows. You'd rather get them earlier rather than later, and there's no garnishing allowed in investing. In other words, you cannot make a decision based on the numbers and then override it because there are strategic imperatives or synergy. If there are side benefits or side costs, they have to be brought into the investment return. So the investment decision says go out and make investments that earn a return that exceeds your hurdle rate. What about the financing decision? The financing decision has two subparts to it. The first is the mix of debt and equity that you use as a business. And here the principle is simple. You want to minimize the hurdle rate you face as a company. So if you can find a mix of debt and equity that lowers your hurdle rate, that's good for you. You could take more investments and investments become more valuable. The second part of the financing decision looks at what kinds of debt is right for you. Long-term or short-term, straight or convertible, in what currency. And here, the principle is a simple one. You want to find the debt that best matches your assets. So if your investments are all long-term, your debt should be long-term. If your cash flows are all in euros, your debt should be euro debt. That's a financing decision. And then you get to the dividend decision. The dividend decision relates to how much you return back to your owners as investors. And here the principle again is a simple one. If you cannot find investments that earn your hurdle rate, that minimum rate that you need to make, then give the cash back to the owners. Now, how much cash you choose to return will depend on how many investment opportunities you have as a company and what you generate as cash flows, and how you choose to return the cash. Remember, as publicly traded companies, you can return the cash as dividends, or you can buy back stock. Will depend on who your shareholders are and what they prefer. That, in a nutshell, or in a big picture, is all of corporate finance. And doing all of this, you have a singular objective. You want to maximize the value of the business you run. Now, let's start with that end game. Why maximize the value? And after all, there are multiple stakeholders in a business. Here's a list of some of them. You have shareholders who provide the equity you need to run a business. You have lenders who provide the debt that you need as capital to run the business. Those are the capital providers. You got employees. Without employees, your business will not be able to run. You, of course, have customers who buy your products and services. You have society, which you're a part of and you've got to contribute to. And of course, you have competitors who might wish for your downfall, but basically coexist in the market with you. They're all stakeholders. You're saying, why in the world that you just described would I put one of these stakeholders first? Here's the reason shareholders get primacy, at least in traditional corporate finance. It's not because they're special, but because they're the only group that doesn't have a contractual claim on the company. Let me explain. If you're a lender, you lend money to a firm and you're not comfortable that the firm will not pay you back, you charge a higher interest rate and you put in restrictions, debt covenants. Lenders are bound by contractual agreements with the company to protect themselves. If you're an employee, and we can debate the strength or weaknesses of the contractual claims they have, you have a union that negotiates on your behalf, your wages, your benefits, and if you don't like them, you leave and go work for somebody else. If you're a consumer, you buy products and services, but there is a contract implicit in those products and services. And if they don't do what the company claims they do, you can lay claims against the company. There is a contractual claim. Society does too, right? Taxes, after all, are a contractual claim you have as a company with society. Regulations, laws, basically, they're contractual claims. Every stakeholder group other than shareholders has a contractual claim. What do shareholders have? They have a residual claim. They get whatever's left over. And because they get whatever's left over, you've got to give them primacy. They are the ones who hire the managers, and managers are accountable to shareholders. In fact, think of the alternative. If managers are not accountable to shareholders and you're a shareholder and you get whatever's left over, why would there be anything left over? So when you look at traditional shareholder wealth maximization, it's not because shareholders are special, but because they're the only ones without a contractual claim. Now, of course, there's a pushback. This play, at least in the last 2 decades, we've had against shareholder wealth maximization. There are people out there, some who should know better, but argue that the objective for a company should be stakeholder wealth maximization. That managers should be accountable not just to shareholders, but to every other stakeholder group. My problem with these stakeholder wealth maximization alternatives is they leave a company rudderless, because you are now serving multiple interests and often the interests conflict. So how do you keep shareholders and lenders and employees and society and consumers all happy at the same time? Business is about making trade-offs, and I need some rudder, some pathway to decide, where to put whose interests should come up on top. It also leaves, in my view, managers unaccountable. If you tell managers they're accountable to everyone, I'm going to argue they're accountable to no one. Sounds like a weird thing to say, but here's what happens. If you tell a CEO that his or her job is to take care of all stakeholders, and let's say share prices are down 30%, they can go in front of shareholders and say, you know what, I had to take care of lenders this year. When the lenders say you're not making interest payments on time, I say, look, employees need to be paid. The employees complain that their wages haven't gone up. I point to consumers. I have to offer the product at a reasonable price. The shareholder wealth maximization objective might not be a perfect one, but given the alternatives, the best of what we have, it does come with limitations that we can talk about, where you can talk about, I call these leakages in the process, where companies can exploit them. But that doesn't mean we abandon that objective. So the objective in corporate finance is to maximize shareholder wealth, and the decision-making process in a company has to be directed towards that objective. With that in place, let's talk about the investment principle. I said that the investment principle requires that you earn a return on an investment that exceeds the hurdle rate. Now, we'll come back and fill in the details in future sessions, but the hurdle rate for an investment should reflect the risk of the investment, not the entity taking the investment. Sounds, again, like a play on words, but let me explain. Let's say you're a safe company looking at a project in a risky business. The hurdle rate for the project should reflect the risk of the project, the risky business, not the fact that you're a safe company. We'll see how this plays out and how we come up with hurdle rates. The debt ratio you should use to come up with the hurdle rate should also be a debt ratio that can be sustained by the investment's cash flows. In other words, if you're a company that can borrow money because you have a history of being able to borrow money, and you choose to borrow money to fund a project, I shouldn't be giving the project the benefits of the fact that you could borrow money, because in effect, I'm subsidizing that project. So hurdle rate for a project should reflect the risk of the project and the debt mix that can be justified by that investment. What about returns? When you look at the returns on a project, and remember these are expected future returns, you can estimate accounting earnings. But earnings are kind of meaningless. You cannot spend earnings. If you're measuring returns well, they should be based on cash flows, cash in, cash out. They should also be time weighted. I'd rather get the cash flows earlier rather than later. We'll come back and fill in the details on what kind of investment decision processes meet those requirements. You got a hurdle rate and return, and you're trying to exceed that hurdle rate. Just as a precursor to the discussion of hurdle rates, we know hurdle rates should reflect risk, but risk comes in so many different forms. In fact, when you think about the risks you're exposed in investing, I would break them down to 3 types of risks. The first is estimation versus economic risk. You're saying, what's the difference? Economic risk is risk that comes from the business you're in, the operations you're in, the risk of actually running a business. Estimation risk is risk that comes from the fact that you might not have collected all the data you need to estimate your parameters right. The reason I draw a contrast is often when people look at projects or value companies, they spend a lot of time trying to get their numbers right. In other words, reduce estimation risk. But I have some bad news for you. Much of the risk you face in investing is economic risk. Nothing you do in terms of collecting more data or doing due diligence can make economic risk go away. Estimation risk versus economic risk. Because when businesses make decisions in the face of uncertainty, they need to know what kind of risk they're facing. The second contrast between risk is micro versus macro risk. Micro risk is risk that is specific to a company or maybe even the sector itself. If you're a semiconductor company, the risks you're exposed to as a company or the entire semiconductor industry is exposed to that is specific to you. Macro risks are risks that affect all companies. Changes in interest rates, the economy going to recession. Those are risks that are across all investments in your portfolio. The reason we draw that contrast is if you're an investor who has a portfolio of companies in your holding, you have companies across different industries, different sectors, I would argue that the micro risk will average out. And in fact, much of risk and return that we will talk about in future sessions is built on the premise that you can diversify away the micro risk and only the macro risk shows up in your discount rate. And then there is discrete versus continuous risk. I'll give you an example. If you're a US company with European operations, every time the euro-dollar exchange rate changes, the value of your European operations changes. That is continuous risk. It's all through every moment of every day. In contrast, if a US company invested in a country with fixed exchange rates, you might face no risk as long as the exchange rates stay where they are. But if there's a devaluation or a revaluation, you could have significant risk. That's discrete risk. In corporate finance, we're very good at dealing with continuous risk. In fact, much of the risk and return methodology we have in finance is designed to deal with continuous risk. We're not that good at dealing with discrete risks, the risks that are, nationalization risk, distress risk that doesn't show up much of the time, but when it does show up, could be catastrophic. So let's talk about how uncertainty unfolds across a life cycle. Obviously exposed to uncertainty across the life cycle, but the amount of uncertainty shifts as you go from very young companies to mature companies. It generally tends to go down. But then again, as you approach decline, it starts to go up again. When you think about estimation versus economic risk, much of the risk you face at young companies is economic risk, because so many things are out of your control. How the business, how the economy, it is economic risk where no amount of collecting more data is going to make your estimates better. Perhaps as companies mature, there's more estimation risk. Their doing due diligence can give you more precise estimates. When you think about micro versus macro risk at young companies, almost all of the risk is micro risk. Will the founder hang in there? How will the business evolve? How will the business model work? As companies mature, you will see more macro risk take over. And when you think about discrete versus continuous risk, if you remember our earlier discussions of failure risk, which tends to be discrete risk, tends to be greatest at very young and very old companies, at declining companies. In the middle, where you've got a business model that works, it's more continuous risk. The nature of uncertainty we face shifts across the life cycle, and somewhere in corporate finance, we've got to bring in those differences. Earlier, I talked about micro versus macro risk that can be diversified away, micro risk that cannot, macro risk. If you think about any company, and you make a risk profile of all the risks it's exposed to, you're going to find that some risks are specific to individual projects that the company takes. A retail company, every time it opens a store, has to worry about location risk and risks that are specific to that store. Think of that as project risk. That retail company, as it opens dozens of stores, is going to see the project risk start to diversify away. In the business you're in, competition can change your fortunes in good ways or bad ways. Company might not be able to do much about that once it's in a sector, unless it decides to go into other businesses, but investors can. Maybe the entire sector can be exposed to risk because of regulatory or legal changes. Again, if you're invested entirely in that sector, you're going to be exposed to that sector risk. But if you're an investor, invest across multiple sectors, sector risk starts to average out. You got exchange rate risk, which can sometimes be micro risk if only your company is impacted. But if most or all companies are impacted, it might start to become risk you cannot diversify with. You got things like interest rates and inflation that you can't do much about no matter how diversified you get. The reason we draw this contrast is when you think about the risk you want to bring into your hurdle rate, you got to think about the investors in your company. And if they tend to be diversified, the risk you care about is the risk you cannot diversify or macro risk. If all of your money is in one company and you're the only owner, maybe you care about all risk. Something to think about when you think about hurdle rates. In terms of investment returns, I said a good measure of returns is based on cash flows. And in fact, it reflects time weighting. You want earlier cash flows. There are two approaches in finance that are based on cash flows and time weighted. One is called the net present value. We take the present value of every cash flow, that's the time weighting, and you discount them all back to today and come up with the net present value. The net present value is greater than zero, your investment is good. If it's less than zero, your investment is bad. The other approach is called an IRR, where you take the cash flows and based on the cash flows in the initial investment, you come up with a time-weighted percentage return, which you then compare to a hurdle rate to make a decision whether the project is a good one or bad one. They're both time-weighted incremental cash flow returns. However, that requires that you have estimates of future cash flows. There are some accounting measures of returns we will talk about, where you take the accounting earnings, and I know earnings are not as good as cash flows, but that's all you have access to as somebody looking from the outside, and you divide by the accounting measure what's invested in a project. You can come up with an accounting return. That return can be just to equity investors, where you take net income, which is equity income, divided by the equity invested in the project, book equity. It's called return in equity. Or it can be to all investors, where you take operating income, which is earnings to all investors, and divide by the total capital invested in that project from both debt and equity. So from the perspective of investment returns, you'll see both play out. Cash flow, time-weighted cash flow returns are optimal, but sometimes the information you have to settle for accounting returns. That's the investment principle, hurdle rate and returns. Let's talk about the financing principle. One of my favorite devices in my classes is a financial balance sheet. Not an accounting balance sheet, but a financial balance sheet. In a financial balance sheet, on the asset side of the balance sheet, you have assets in place, investments that a company's already made, and growth assets, value that I'm attaching to investments you're going to make in the future. And then the other side of the balance sheet, there are only two ways you can fund a business. You can use your own money, equity, or you can borrow the money, which is debt. So in the financing principle, the question you're asking is, what's the right mix of debt and equity for my company? And is there a right type of debt for my company? So in terms of that trade-off, let's think about the pluses and minuses of debt. We'll come back and elaborate more on this in a future session. But the biggest plus of debt is built into the tax code. Interest expenses are tax deductible, but cash flows to equity have to come out of after-tax cash flows. The higher the tax rate, the greater the tax benefit to borrowing. And on the other side, the biggest minus is when you borrow money, you put your company's survival at risk, bankruptcy or default risk. For companies that get large tax benefits and have low default risk, debt is good, it'll increase their value. For companies that have to worry about default risk more and have low tax benefits, guess what? Equity is the right way to fund your business. So when you think across the life cycle and we think about the mix of assets in place and growth assets, you can already start to see that the mix of debt and equity is going to shift as you go across the life cycle. In terms of financing type, the core idea is a simple one. You want to match your debt up to your assets. You say, why? Because it reduces default risk. Here's a very simplistic example. The first business has matched the debt up to its assets. What that basically means is as the business goes up and down in value, the debt goes up and down in value. This business is never going to default. The second company has borrowed about as much money as the first one, but has mismatched the debt. So the value of the business goes up and down, but the debt does whatever it wants to. It's kind of independent of the value of the business. Notice this segment where the value of the firm falls below the debt. Technically, this company is bankrupt. The reason we want to match debt up to assets, it reduces default risk, and by doing so, lowers your cost of borrowing, as well as reducing the risk of failure in the company. Which brings us to the third and final principle. In a perfect world, here's how companies would decide how much to return to shareholders. They'd start by looking at their investment choices. They have lots of investments that are good, which are good investments. They will take those investments with their capital. They will choose a financing mix that minimizes their hurdle rate. And then if there's any cash flow left over after taking their good investments with that right mix, they will return that cash to shareholders. We'll see how companies often adopt very dysfunctional dividend policies, but in a perfect world, be residual cash flow. So you can already see that if this is the case, then what gets returned to shareholders should change on a year-to-year basis, because that residual cash flow will be high in some years, low in others. In practice, though, when you think about what these cash flows will be, there is a way in which you can compute what the company can afford to return. You start with net income. Remember, dividends and cash return is to shareholders, so you start with a measure of earnings that is equity income. You add back depreciation and amortization. Why? Because depreciation and amortization is an accounting expense which lowered your net income, but it's not a cash expense. You do subtract out capex. Why? Because it's a cash outflow. I don't care what the accountants say about it being an expense. It is a cash outflow. And then you subtract change in non-cash working capital. You're saying, what exactly does that capture? It captures what you're investing in short-term assets. In effect, you're starting with the income available to equity investors. You're netting out the cash invested in long-term assets by looking at that capex net of depreciation. You're netting out the investment in short-term assets by looking at change in non-cash working capital. But remember, as an equity investor, you are allowed to borrow some of that money you need for reinvestment. It reduces your reinvestment need. So if you have cash coming in because you borrowed money, you add that in. But if you have cash going out because you got to repay old debt, you net that out. And what you're left with is called free cash flowed equity. Fancy word, but it measures cash left over after every conceivable need has been met. In a perfect world, that is what you would return. Until about 30 or 40 years ago, the only way companies returned cash, publicly traded companies, was in the form of dividends. The problem with dividends is they tend to be sticky. You tend to pay the same amount in dividends year after year because they're modeled after coupons on bonds. They tend to be timed. They're paid out at regular intervals, and they tend to be to all shareholders. So if you're a shareholder in a company, you get the dividends. Over the last 4 decades, there's been an alternative to dividends, which is to use the cash you have available, that free cash flowed equity, and buy back stock. In contrast to dividends, stock buybacks tend to be flexible. In good years, you buy back a lot of stock. In bad years, you don't. It tends to be opportunistic. You can determine when to buy back stock. Maybe you'll buy back stock when your stock prices are down. And it can be selective. When you buy back stock, only those people who need to cash out sell their shares back. The remaining shareholders, rather than sell the shares, hold on to their shares and get a higher price. To me, buybacks are just flexible dividends. And as we look at the statistics on buybacks and dividends, not just in the US, but across the world, maybe we can get a clue as to why more and more companies have shifted away from dividends to buybacks. So in a broad sense, there's the investment principle, the financing principle, and the dividend principle. And they cut across all companies. Now here's where the life cycle makes a difference. What I will argue more emphatically in the future sessions is your emphasis as a company on which of these 3 decisions, the investment, financing, will shift depending on where you're in the life cycle. Early in the life cycle, every young company, it's all about the investment decision. Think of why. It's all about future growth. If you don't make the right investments today, you have no value. The financing decision is empty. You have a money-losing company, your business model is not in place. Of course you can't borrow money. And of course, you can't return cash. So the financing and dividend principle become inanimate early in the life cycle. It's all about the investment decision. And that carries through much of the growth years. Growth companies should be focused on making the investment decision right because their value rests in the investment decision. As companies mature, there will be a shift away from investments to financing decisions. In fact, when companies talk about lowering the cost of capital by changing the mix of debt and equity, that's a signal that they're maturing as companies, because a high growth company that's making 35% return on projects frankly doesn't care whether it's got the right mix of debt and equity or not. So the financing principle will become more emphasized as companies mature. And then you're going to decline. Remember, your objective is to return cash to your shareholders. The dividend decision rises to the top. Every company faces investment financing and dividend decisions, but as you move through the life cycle, you'll see the emphasis for companies shift. So if you're a young company and you don't have a CFO, remember, as long as you have somebody who can raise capital for you, you're going to be okay. If you're a mature company and you don't have a project team, maybe you can get away with it. And if you're a declining company, maybe you should send everybody home. And all you have are the people who divest assets and return cash to shareholders. That's an extreme view. But clearly, as companies move through the life cycle, you'll see the emphasis shift. In the next three sessions, I'm going to take the investment decision, the financing decision, the dividend decision separately and look at how the way you approach these decisions changes across the life cycle. But I hope you found this introduction to corporate finance useful, at least in the context of a life cycle. Thank you very much for listening, and I'll see you soon.